Well, good afternoon or good morning. It's a pleasure to be here to speak on behalf of UBS's oil and gas team. My presentation today is consistent with the theme of the conference and is about the growing importance of creating cross-border joint ventures and partnerships. The obligatory legal disclaimer. So just to frame the discussion, in the next 20 minutes or so, what I'd like to cover is the following agenda. First, just provide what I promise will be a very short introduction into UBS and how we work in your industry. Secondly, highlight the rationale for some of the joint ventures that we're seeing from an investment banking perspective. Discuss some of the factors driving an increase in joint ventures and partnerships, and in particular, the emergence of the North American shale ventures and where they may be heading. Finally, I'd like to wrap up with some quick thoughts on the future of venture activity. First, as mentioned, just a quick introduction to UBS and our energy practice on the investment banking side. At UBS, we have more than 120 professionals specifically focused on energy, oil and gas investment banking. These professionals are across the Americas, EMEA, and Asia Pacific. A number of my colleagues representing all three of these regions are here with us today. We serve the spectrum of energy companies across upstream, midstream, downstream, and oilfield services, encompassing national oil companies, international oil companies, independent, sovereign funds, and states. In our work, and as a basis for some of my comments this morning, my colleagues and I have worked on a number of joint ventures and partnerships. The majority of the deals we advise on, whether strategic transactions or financing, involve more than one country or region. And as mentioned, many of these transactions have taken the form of joint ventures and partnerships. Currently, we're advising PTT-E&P in the acquisition of Cove Resources. A successful transaction for the Thais will establish a partnership with Anadarko and others in the exciting LNG development in Mozambique. Last year, we advised Galp in their $4.8 billion joint venture with Sinopec in the Brazilian offshore. And for what I promise will be the last page of the UBS introduction, but important to provide some context for my comments, early last year, we helped PetroChina conclude its first investment in Europe, where it created a $2 billion refining and trading joint venture with INEOS. And on the North American shale front, we also helped advise Reliance on its $3 billion joint venture with Pioneer in the Eagle Ford shale gas development. What I would say is all these transactions really highlight the four primary elements that we find necessary to succeed in the global energy business, namely access to resources, which I think is mentioned through some of the previous speakers, usually require some local knowledge, technology to identify and unlock the opportunity, capital to fund the opportunity, and execution to bring it all together and commercialize the opportunity. While some companies specialize and excel in one or more of these elements, it's increasingly rare to find a company that can continuously execute against all four. And thus, the opportunity, in some cases the imperative, is created to form joint ventures and partnerships that can bring all four together. As we know and we've heard through prior presentations, there are a diverse set of participants in the global oil and gas business. While there are clear imbalances between the main producers and the net importers, these participants usually want to focus on the upstream, whether they have a lot or a little of reserves and production. And the differences in their objectives creates the opportunity at a given point in time to find compatibility and complementarity in joint ventures or partnerships. It's also worth mentioning that JV structures have become increasingly popular during the global financial crisis, given the lack of credit and lower risk appetite among many of the players. In addition to their objectives, industry and the financial market dynamics are also conspiring to create a fertile backdrop for increased joint venture activity. Let me just mention a couple of those. The first is, and I think, again, we've seen that in a couple of presentations this morning, that exploration is really gaining more importance in growing the resource base. Genuine breakthroughs in both technology and geological understanding is encouraging more activity. Recent discoveries, which have tended to be made by a number of the mid-cap independents, have opened up new plays, and this has left some of the large participants scrambling to get in on the act. Second, technology is driving unconventional oil and gas growth. Offshore and subsea technologies are opening up new opportunities in deeper waters. Harsh environments with high pressure and temperatures are increasingly accessible. And new horizontal drilling and fracking techniques have revolutionized the onshore North American oil and gas industry. Third, we have witnessed periods of capital market limitations and the presence of cash-rich international oil companies and resource-hungry national oil companies. Undervalued stocks and closed equity markets are forcing less well-funded players to seek joint ventures, partnerships, farm-outs, and in many cases, outright sales. The international oil companies, on the other hand, with over $90 billion in excess cash currently on their balance sheets, are actively seeking to participate in these opportunities. And also, national oil companies are really what we're finding dominating many of the auctions for the large producing properties or near-term development opportunities, as well as some of the recently discovered resources. Fourth, managing political risk is always and continues to be critical to the global oil and gas industry and in helping to drive joint ventures and partnerships. Activities in politically difficult areas tend to be easier if companies from two countries participate. And participation in the U.S. shales by Asian NOCs through properly structured joint ventures largely avoids CFIUS and other politically related issues. If we look at the volume of joint venture activity, it's interesting to note, as the left side of this chart shows, that the overall numbers of joint ventures across all industries has increased over the last 4 years. This increase in the number of overall joint ventures has occurred while at the same time, as the solid line suggests, the overall merger and acquisition activity has been flat to declining, which I think begins to hint at the role the availability of capital has played in the increase in joint venture activity. The right side of the chart shows the increase in oil and gas-related joint venture activity, which has occurred at the same time as an overall increase in merger and acquisition volume, which speaks to the dynamics in our industry, as many of the speakers have touched on. Also of note on the energy-related joint venture activity has been the emergence of the North American shale-related joint ventures, noted at the darker color on the top of the bars. These North American shale ventures have raised a significant amount of capital, with at current estimates raising around $50 billion in capital, considering both upfront cash payments and drilling carries. These shale-related JVs have quickly increased with the discovery of prospective and new resources and the capital intensity required to develop them, along with their potential application around the world to shales in Europe and in Asia. Let's spend a few minutes further examining the logic of these JVs that have involved both IOCs and NOCs. In America, these shale ventures have become somewhat commonplace. For some independent upstream players in North America, these JVs have become somewhat of a strategy in and of themselves. It's fair to say that the emergence of shale joint ventures has been from a confluence of events. For independents, the need to establish joint ventures has largely been driven by the need for capital to fund drilling, to hold leases, and develop a very capital-intensive resource. All the while, the independents strive to maintain control of the resource, the operatorship, as well as control of the production through marketing. For the NOC and IOC, the motivation to JV is largely to gain access to the shale resource and learn the technology in order to apply the learning to their own resources at home. The JV also has helped diversify the risk for some of the independents. And for the IOC and NOC, all that in addition to participating in a multi-year perceived relatively low-risk production ramp. What will be interesting to observe is how many of these joint ventures endure with the passage of time. If you think about the life cycle components of a North American shale plays, one can think about it in terms of three distinct phases. In the first phase, which is particular to North America, the rights to the resource must be secured through leasing acreage from a myriad of landowners. This skill set has largely been the strength and domain of the independent upstream company. Once a land position is established, the drilling, completion, and stimulation, while varying in approach, is largely carried out through service companies. While the participants work to keep these techniques proprietary, the intellectual approach gets largely disseminated into the marketplace. The third phase, the management of the resource, has traditionally been the strength of the IOC and producing NOC. Both these players devote significant human and research resources toward developing optimal development plans and approaches. On the other hand, independents tend to be valued on production growth, and while oversimplifying, tend to want to produce the reservoirs in a manner that leads to the greatest initial production rate and maximizing production growth, which in turn drives their share prices and therefore their cost of capital. So while independents have largely managed to retain control of these existing JVs, the potential for misalignment of interest increases with time. Thus, as I've discussed, there have been a clear set of catalysts that have conspired to create a fertile environment for North American shale JVs. We are still in the early phases of these partnerships. As always, there's a risk in oversimplifying regarding these North American JVs. No doubt some of the existing JVs will succeed and evolve into long-term alliances that may replicate in the NOC's home country or elsewhere. Some of the JVs may well dissolve with one partner buying the other. It could well be that some NOCs that have considered a North American shale joint venture with the idea of gaining experience with the technology may find that an alliance or acquisition of a service company may be a better route. And finally, some of the independents may end up being acquired by another party, and the joint venture IOC or NOC partner is confronted with a set of choices as to whether and how to move forward with their venture. We can look to the financial markets to see what we can learn how they think about these North American joint ventures. On the left-hand side of the chart shows 3 bars with how the markets have rewarded independent participants across a number of joint ventures with both NOCs and IOCs. The 3 bars each represent a time frame of relative share performance of the independent JV partner relative to its peer group. The first bar shows an outperformance versus the peers of slightly over 5% for the day of the announced joint venture. The second and the third bars show the same outperformance a week and a month after the announcement. As you can see, the markets on average have rewarded these independents engaging in shale JVs with IOCs and NOCs with enduring premiums versus their peers. This observed positive market reaction has not been lost on the independent companies, further stimulating a desire to engage in additional joint venture activity with applicable assets. On the right-hand side, the chart examines how the financial markets are valuing NOCs, IOCs, and independents. I'm not sure you can really draw any observations about joint ventures in particular, other than to say that the markets have tended to value independents most highly, followed by NOCs and IOCs, and that this valuation dynamic has tended to be fairly durable in the recent past, except in times of extreme financial dislocation, where we see a flight to safety, which tends to benefit the IOCs. However, we still are at the early days of these North American shale ventures and developments, and there are a number of dynamics that hold the possibility of changing the game, such as gas exports via LNG, increased integration along the value chain, and others that will need to play out further before the financial markets provide a useful indication as to whether these JVs have been successful for their participants. However, one clear point to make is that JVs have and will likely continue to play an important role for many participants in accomplishing their shale-related objectives. Measuring success need not be a function of how long the JVs last, but more likely a function of ensuring that the provisions of the joint venture are tailored around the objective each party needs to accomplish, while being faithful to the key structuring considerations around ownership, governance, dispute resolution, capital structure, exit provisions, and tax. We've already seen an evolution of the structuring of some of the shale JVs, with each of the key elements evolving to more specific, objective-driven contractual obligations. For example, in the early days where learning the technology and gaining operational experience was the key driver for the IOC and the NOC, the approach was degree in principle, or better said, perhaps more of a trust me approach. We are now seeing these objectives spelled out in very specific events at specific points and times with triggering mechanisms. In addition, to better align the economic incentives of the parties, we have seen economic triggers built into the disbursement of funds to better align the commodity price realizations and the partner's interest overall. With joint ventures, clear definition of strategy and mutual objectives and a user-friendly dispute resolution mechanism are really the key to success, with careful consideration of how objectives may diverge over time. We expect these JV structures to continue to evolve as we go forward. Joint ventures, I think, as we all know, are really the mainstay of the oil and gas business. Our industry is somewhat unique in the forms of cooperation and partnership, yet at the same time, significant competition exists among participants. As the research on the left suggests, there are many reasons to consider a joint venture or partnership. Given the trends discussed, we expect joint venture construction to continue at the current pace. As the right-hand portion of the page reflects, there are a multitude of potential joint venture combinations, along with some examples, including, as we've already discussed, North American shale JVs with independents and between IOCs and NOC. But in addition to that, as we heard from some of the early speakers, JVs between IOCs and NOCs, also NOC to NOC joint ventures, downstream joint ventures between independent NOCs, and of course, IOC to IOC joint venture. In conclusion, joint ventures and partnerships are a mainstay of the global energy industry. Properly structured JVs offer advantage combinations of resources, assets, capital, expertise, and labor. And whether long-lasting or short-lived, JVs must be judged relative to their objectives. And finally, trends and forces at work suggest increasing numbers and varieties of joint ventures and partnerships. Thank you for your attention.
Thank you very much, Thomas Langford. I would like to ask you to stay still with us for a moment. I'd like to give you the opportunity.
Invite my colleague up, Philip Wolf, who runs our
Philip,
EMEA
very
Energy
good.
Practice.
So that's a powerful double. Now I would like to invite you to take the opportunity of asking questions. Okay, microphone, please.
Conor with the Canada Pension Plan. Tom, where do you think we sit within the cycle of assets for sale within the market that you're seeing right now? And maybe some context in terms of where or what those assets are.
Sure. Let me focus my response really on North America, then I might turn to Philip to talk a bit about EMEA and perhaps the rest of the world. In North America, it's interesting. Every time I think we believe that we are going to see a slowdown in the number of joint ventures, just with respect to when you look at the plays, when you look at the acreage, and you look at the mapping of where participants are and where joint ventures have occurred, you continue to ask yourself the question, just how many more of these can come along, and yet we continue to see those. And I think much of that is, in fact, driven by capital imperatives, as well as the recognition that in many cases, participants are using these joint ventures as a way to establish a value for their resource, hoping that that will then look through to the markets and get reflected in their share prices. So an interesting way to attempt to crystallize value. As we know, there's just a tremendous disparity between oil, liquids, and gas on a price realization in North America, largely as a result of so much of this increased activity and yet the inability to get it out of the country. And given that so much of the activity has been generated really by independents that are very dependent upon not only the capital markets, but also banks and banks through reserve-based lending, in many ways, while the trend really started out on the natural gas side, and of course, as we know, then with gas becoming distressed in its price realization, you had companies beginning to try to transform to become more liquids-oriented, whether that was crude or whether that was natural gas liquids. And of course, in order to manage that transition requires capital to acquire land, capital to frankly, commercialize the resource as quickly as possible in order to realize that value. So as a result, many of the companies find themselves with very highly drawn liquidity facilities as part of that transition, and their ability to continue that exercise in many ways will be not only a function of the capital markets, but also the willingness of the banks to continue to roll that paper, because their borrowing bases in essence are established on their natural gas resources, yet their capital spending is going toward oil and liquids. And the extent to which, of course, the price is low on gas, that reduces the value of their underlying assets, that reduces their borrowing base, and the extent to which they've already borrowed too much, then it will force them to begin to think about more severe, more structural solutions in order to ensure that they go forward. So I think that's a long way of saying that that we are very dependent upon how the market evolves in with respect to specific commodity prices. But on current trend, I think we would expect to see more merger and divestment activity and restructuring of companies, largely due to the point of access to capital and really liquidity concerns. So I think our view would be that we expect a lot of the large IOCs and NOCs to be beneficiaries of that have the balance sheet, that have the capital, and expect to really see a bit of a pickup of activity in that regard. Philip, comments on the rest of the world?
I think outside of North America, the reserve-based lending market is less well developed, and people are less likely to be sort of forced to sell assets. But people will, or corporates will prefer to joint venture and sell partial stakes in assets through either farm outs or full joint ventures, rather than sell out assets outright. And any assets that are sold outright will be where there's a small independent that runs short of money and wants to take all its money off the table and trade in that respect. So I think a good example is the Galp Energia transaction we did earlier this year, or closed earlier this year, where Galp Energia needed to raise several $1 billion to fund its development plans till first oil in Brazil, and ultimately they sold a 30% stake with about $5 billion coming in from Sinopec. So they maintained control, and they went from being one of the more levered oil companies in Europe to being one of the least levered oil companies in Europe. Yet they still had their assets and still had as much dollars in the game, they just had less of a financing risk. So I think JVs are going to be more, there are more of those than outright asset sales.
Other questions?
My name is Victor Mashali. I work for Nigeria LNG. The question has to do with, you're saying that shale gas revolution in the US has been driving joint ventures. The question is, with shale gas priced at $2 per MMBTU, how do you see this model sustained, and how bright do you see the prospect? Because your cash flow is actually a function of prices. Well, do you see these prices staying flat in the years ahead? And if they would, how useful are these joint ventures relative to other opportunities elsewhere?
Well, I think what we've seen, and of course, not surprisingly, the just dynamic of the industry participants and continued application, if you will, of shale technology, which of course, as we know, really was first surfaced primarily with gas-related reservoirs, now moving to liquids and oil, has really created a very, very strong wave that has continued and in many ways increased the level of overall activity. I think with respect to commodity prices, I think most players in the North American realm, in any event, are certainly not necessarily looking for any kind of near-term bailout, if you will, or parity between the gas molecule or the liquids or oil molecules. So many of these joint ventures, as I say, most of these plays have some combination of gas, natural gas liquids, as well as oil. So we've seen a distinct reorientation within the context of some of these early joint ventures toward and directed toward the commodity where the best realization can be garnered. On the other hand, I think part of the pressure on the gas price in the U.S. has been the fact that many of these early joint ventures in gas particularly were structured around, again, an upfront payment plus a very large carry. Much of the carry was being utilized to, in essence, drill the existing acreage in order to hold that acreage through production. Otherwise, you would forfeit it depending on the duration of the lease. So therefore, while the commodity price signal in and of itself wasn't necessarily suggesting that participants should continue to drill, nevertheless, they had the availability of the capital through the joint venture structure. They were very motivated, and you had very differing economics depending on the independent versus the IOC or NOC. So you continue to see high levels of activity, notwithstanding a falling commodity price. I think in many ways we've largely worked through that backlog, if you will. So I think we're all observing the gas rig count slowly coming down below magic numbers of 600 and so, which would begin to suggest that perhaps with a more normal winter or perhaps a very hot summer, that we may begin to tighten up the market to begin to see some increase. So I think in some ways we've worked through some of the gas-related dynamics, although there's still a lot of wells that have been drilled but not completed. And really the focus, as I say, has been on both with respect to some of the historical gas ventures as well as the new ventures, really focusing more on the black oil or the gas liquid commodity where economics are still quite favorable and activity is being motivated.
Okay, there is a question here in the front.
I'm Sumaya Athmani from the National Oil Company of Kenya. I'm curious to know, because one of the concerns many host governments are having at the moment, particularly in frontier or newly emerging areas, is that a number of the particularly smaller exploration companies are coming in not so much for the work they can do, but for the money that they can make, particularly when they announce a joint venture. And I think the slide that you've shown reflecting value of increase in share price on the day of the announcement compared to what happens perhaps a month later is very interesting and perhaps instructive of some of the things that host governments would do to prevent some of that activity which they're not very happy with. I'm curious to know what your thoughts are on how this area may pan out going forward.
I think in some of these frontier countries and provinces, when you look back 3 or 4 years, the major international oil companies were not interested, and the national oil companies generally are more focused on development and production. So this sort of blank sheet of paper and this new opportunity was overlooked by the large IOCs. So this space was filled by more entrepreneurial independent oil and gas companies whose market cap could be anything from $50 million to $1 billion, so quite small. And they're taking a higher risk, and therefore they're hoping for a higher return. Cove is a good example of this in Tanzania, and obviously they're also present in Kenya and have done well there too. And they will have to pay some capital gains tax on the way out of Cove. So the governments can do that, but I think if governments suddenly change the rules too dramatically, with hindsight, the governments themselves will lose faith with the international investors and the international oil and gas companies. But I think there is a life cycle of a new province, and sometimes it's small companies and then they get taken over by other independents or other IOCs or NOCs. So I think there is an important place for these IOCs that go to places that were 5 years ago considered really difficult, and why on earth are they exploring there? And they create value.
Okay. I say thank you very much.
Thank you.
Tom Langford and Philip Bolton.